This week, prepare to be either annoyed or frustrated when you find out the hidden cash balance you haven't drawn from your business. Welcome to the Profit Cash Growth Podcast. This is the podcast for 6 and 7 figure business owners who are looking to grow a financially successful business. My co-host, Claire Hancock, is a finance director, chartered accountant and entrepreneur. And every week, I'll be exploring guidance and frameworks designed to help you increase your profits, improve your cash flow and grow your business. So what have you got to tell me this week, Claire?
Not much. I've just been work. I think I've literally worked like 12, 15-hour days every day. So I have no life at the moment.
I know, that's just people issues, isn't it? You've got someone on long-term sick at the moment, haven't you? Which is a big problem, but...
We're getting there though. And I've embarked on a new little project to build a client portal that I'm coding, which has taken up a bit of my time. So those two things combined means that, work is my life. And that's made you very grumpy, hasn't it?
Well, that's a nice segue onto this week's news story of the week. So this week's news story of the week, Claire, is the headline just simply says grumpy Brits.
Very true.
Yeah, I saw this one in the Sunday Times. It was a little snippet, and it's the GfK Consumer Confidence Index, and it's basically it's pretty depressing. Basically, it's been in negative territory since 2014. So basically, zero on the index basically means content. So anything under 0 is unhappy, anything over 0 is happy. And prior to 2014, it was over 0 for most. No, this graph doesn't go back far enough. I meant prior to 2014. So the graph you're looking at starts at 2014, so it starts at 0.
Okay.
But I can tell you because I know this is the whole point of the story, that before that, it always remained in positive territory for as long as since the war, basically.
Which war?
World War II.
Okay.
So basically, it's always remained like slightly above 0 or positive territory. It's never really got above sort of 25 in positive. Don't get me wrong, we're not super happy people. But basically, since 2014, it hasn't been in positive territory. And most recently, it dropped to the biggest negative of minus 50 in around 2023. That was the Liz Truss whole thing that year. That was a bad year, wasn't it?
And the Russia war was February 22, was it? Then the Queen died in September 22, I think.
It was a bad 23 was a really bad time
No, that must be 23 the Queen died, because it's just before Liz Truss, wasn't it?
Yes. And then the last couple of years, 24, 25 and into 26, it's basically been hovering around this sort of minus 22 sort of position there. So, how do you... they're calling it a ripple of fear.
On the one hand, I feel like this. I feel like everything's really negative and really bad, and it's difficult to not let it get you down. But then at the same time, I'm just like, can we just pull ourselves together? Like, this is just life. There's always challenges. There's always new things thrown our way. There's always taxes to pay. And we can complain, or we can just suck it up and get on with it and try and be happy.
Actually, this would have been another, just saying there's always taxes to pay. It's not quite as simple as that, because a news story I read yesterday is that we have increased taxes at the highest rate of all the G7.
Yeah,
Did you read about this?
Out of our control. And I think that's like so much
it's out of our individual control. Yeah, just crack on.
So much of this happiness
Actually,
issue,
is that true in a democracy? Is it out of our control?
Well, it pretty much is, because
I know what you mean.
Look, so much of this is stuff that is like really out of our control, and we let that get us down, and we need to really try focusing on what can we control and only worrying about those things. And that's what I think generally the UK population has just got worse and worse of believing that things are being done to them. And when you believe that something's been done to you and you become a victim of something, then you do feel very much like life is hard.
But I think once you're in that place, you can't come out of it, can you? How do you come out of it?
Well, you can come out of it. It's a mindset issue.
But mindset's habitual. So unless people get coached out of it, which is hard. You know, you can't change somebody's mindset.
Agree. Yeah,
that is a slog to actually coach somebody's mindset back out of it.
Yes.
You're going to take an entire nation out of depression into...
My point is that it is possible, and that this is a self-created issue that we face in this country, where there's a scale, and it's about how much you feel like you are in control of your own destiny. So do you believe in something like fate? Do you believe in luck? If you believe in those things, then you believe that generally
things are
speaking,
being done to you.
Things are being done to you.
Yeah.
And that has the impact of when those things are negative, you feel victimized and you feel like a victim and you feel out of control.
So that obviously this means that that's how majority of people feel.
Yes. And we see that with, like, for example, the explosion of people being diagnosed for things.
Mm-hmm.
So diagnosed for ADHD and diagnosed for dyslexia and all of these types of things. Well, they may be very real issues that people face. It's as soon as there's this label on it, people seem to say, oh, I don't need to worry that I'm not organised. It's my ADHD.
It's my whatever.
And so therefore they feel like they're not in control of this thing. And rather than trying to better themselves, better their life, make more money, all of those types of things, get a better job, move to a bigger house, all of these things, they just say it's out of my control. I can't do anything about it because I'm a victim of this, or I suffer from this.
Well, I think it did summarise at the bottom here that they noted that since the index began, that the average score was -11 anyway. So the fact we're at -22 is not good, because that is like double the average. Like it's like twice the average. Am I saying that right? Twice the average backwards. So it's not a great place to be. But we're basically always in negative territory.
We are just grumpy fuckers, basically. Yeah.
2014 was a great time. So 0 is probably as good as it's ever going to get. Really what we need to do is we need to scrape that 22 back to 0 so we can move forward with things. So great, lovely. Well, I thought that was an interesting tidbit. We're gonna cheer everyone up here by finding some extra cash, aren't we?
We are.
Yeah, in this week's deep dive. So I need to know what this means, Claire. Finding hidden cash in my business. I honestly, apart from the wad that's in the safe, and that's not linked to the business, I don't really know why I'm hiding cash in my business.
Well, Simon,
what are we talking about this week?
You have a very well-run business from a cash perspective because you have an exceptional FD working for you. So from that perspective, you don't necessarily need to worry about this. But this is something...
Do I not have this problem? So I'm not going to find any extra cash out of this conversation?
No, you're probably not.
Are you joking?
Well, look...
For frick's sake.
We have been refreshing all of our clients' monthly board packs, and we have been putting KPIs in. And we've been putting up to 5 profit drivers and up to 5 cash drivers. And what we have found is that every single client has ended up with this one KPI, which is why I wanted to talk about this today. And that is the gap between equity and cash.
So to put context to this is what you mean is that your reporting, because of the size of your clients, is not cookie cutter. Each of them is bespoke. So they all have different dashboards and different things based on what's really relevant for their business. And actually, some of those KPIs can drop in and out depending on where the business is going at any time. But you're saying that this is one correlation you've seen in every business, that this KPI is concurrent with everyone. So therefore, you put it out and said, let's talk about this.
Yes.
Got it.
Okay. So equity versus cash. Basically, this in a nutshell, this is how we've been explaining this to clients, is if in your business, when you're very tiny, profit normally equals cash. You make £1 of profit and generally it lands in your bank account at the same time. So therefore, your profit and your cash never get misaligned.
Yeah.
Okay. Once you've made profit, the only way for small businesses, the only way to take that out of your business is via dividends.
Yeah.
Okay. So when you're in a small business, your cash and your profit stay aligned.
Yeah.
As you get bigger, that's not reality.
Why do they stay? Well, maybe I make these assumptions. They stay aligned because you don't have many customers, you don't have much income coming in, you don't have much export going out. You're probably super on the accounts payable. So like you pay invoices really quickly.
You're stepping ahead.
Oh, am I? Okay. Sorry. I'm just trying to explain. I'm just trying to see from my perspective. Like
the equity in your business is essentially all of the years of profits that have not been paid out as dividends.
Okay, so when I see that bit in my accounting system that says profit available for dividends, that's what you're calling equity?
That is equity, yeah. So it will be at the very bottom of your balance sheet.
Yeah.
It will sometimes be called shareholders' earnings, equity, capital and reserves. All of those sort of descriptions mean the same thing.
So that is that annoying number that I say to you, how do I get that? Because I haven't got the money in the bank to pay it. So how do I actually pay it?
Yeah.
Okay.
So over the years, if you might make like 200k profit every year, but you probably only take 100k dividends, maybe. Yeah. So you've got a difference of 100k.
I never really understood why I don't get the full profit. I can't take the full profit.
So you've got this difference that sits there and builds up over the years. You've got retained profit that's not yet been paid out as dividends.
Yeah.
Okay. And some businesses, that number gets quite sizable. Like we've got businesses that have got like multi-millions sitting in retained earnings, but there is definitely not multi-millions in their bank account. So what we end up with is a situation where there is retained profits that could be paid as dividends, but the business owner can't take the dividends because there's not the cash there.
Okay.
So this number essentially tells us the amount of cash that is tied up in your business.
Interesting. I might be going off on a tangent here, but you've just got me a little thought here. If there's true equity in the business there and you can't access it due to cash, can I go to a bank and lend against that?
Well, we'll talk about that in a second.
Okay. Sorry.
So the reason why we like this number is because it's really bloody easy for people to understand. It's the profit you've made that's not yet landed in your bank account.
Okay.
And it's the opportunity.
Yeah.
So if you've got a cash, so your equity less your cash balance, if that's 500k, that tells us that there is 500k cash tied up in your business, and that's the opportunity of how much cash we could free up. So we might say, okay, we're going to aim to free up 10% of this.
Okay.
Yeah?
Yep.
So that's why this is a really, really powerful number.
You're trying to basically take a gap and close it.
Yes.
With strategies, which I'm guessing you're going to tell us what they are.
Absolutely.
Okay.
Now, the most common areas that cash gets tied up in your business, what we want to do is if you've got 500k of cash tied up in your bank, tied up in your business as an example, we just want to say, where is that money?
Yeah.
So a lot of businesses will have debtors. They'll have cash owed to them by customers. So they would have invoiced customers and essentially made profit, but they haven't yet had that money in from customers.
Yeah.
Okay. Then if you hold stock, that's another area where actually, that's going to be really, really difficult.
Yeah. I always say this to you because I guess we've never owned product-led businesses. And like when I listen to people talk about their product-led businesses, it just like blows my mind. Like I was listening to this guy recently who had like an Amazon reselling business and whatever else. And like he's holding £1 million of stock, but like they've not borrowed any money and they started with no money. So he's basically built up that £1 million of stock from his profits, I'm guessing.
Yes.
So all he's done is he's not realised any profits in his business. He's just turned all of his profits into stock. And now he's got £1 million of his own money sat in stock in the business.
Yeah. So debtors, money owed to you from your customers, and stock are going to be obvious places. And then the other place is going to be mostly any assets that you've got. So think about fixed assets. So if you've got, for example, like computers, company cars, things like that, if you've paid cash for them, or even if you've got finance on them, you might normally only get like a loan for like 75, 80, 90% of that asset. So the rest of it, you've had to use your cash to pay for, normally a deposit.
Yeah.
So they're the most common areas that cash gets tied up.
Okay.
And we see this quite a lot, actually. I've done about 10 monthly meetings with clients this past week. And we had 4 clients that had this issue where they're making profit.
Yeah.
So, they've got a really healthy profit. They're making literally like tens of thousands of pound profit every month.
Yeah.
But their bank is just constantly empty and their cash is just draining and draining and draining and they can't work out where it's going.
Okay. It's really interesting, this, isn't it? Because kind of we talked about this before and this is becoming like really clear how this sits. And we've talked about the whole like the kind of bookkeeper, financial control and then financial director sort of positions with it. So, and this is interesting because what you're describing is the revealing of this and the reporting of this is very much FD level work where you brought this thing, but actually the strategy to manage and close this on an ongoing basis is what I would call financial controls.
100%, yeah. So this is then what a financial controller should do.
Both,
so it would be, okay, let's look at if you've got your debtors, what can we do around your credit control?
Yeah.
What are all the ways that we can speed up customers paying you? And that's the type of thing that we're doing in a monthly meeting versus a quarterly meeting. Our monthly meetings, we frame this as, what can we do in the next 30 days to move this?
Yeah.
And it may be that we just get one customer to pay you quicker.
Yeah.
It's like these small
It's
little
tactics. It's like
1-2% gains that add up over the year. Because if we do a 1% gain every month, we've made a 10-15% difference over the year.
Yes.
So that's what we're doing on a monthly meeting. Whereas on a quarterly meeting, it's much more strategic. It'd be like, what new product could we sell, or what new industry could we go after? That type of thing. It's very different.
And this is really interesting because we did an episode last week about changing accountants and are you with the wrong accountant? And this is a real good example of how, like, you know, yes, you might pay more for a super accountant or a financial control system or various other things, but my God, they're going to help you put cash in your pocket. That's some of money you can see that you can never take as money. If you work with those right people that move that strategy, all of a sudden you could be putting 6 figures into your pocket that you currently can't do. And so, you know, that just pays for itself time over, doesn't it?
Yeah. It's little things like we did a cash flow forecast. We do a weekly cash flow forecast, and we did one for our client, and we did it last week. And by the time we came to have the meeting, it was 7 days overdue. And the number had moved quite significantly from what we forecast. And it was a new client, had moved quite significantly. And we were like, why has this moved so much? And we spotted that it was because the bookkeeper had gone through and paid loads of invoices before they were due. So we'd done our cash flow forecast based on the due dates of the invoices. And then the bookkeeper had just gone through and just paid based on invoice date and not due date. And so that was an opportunity. We were like, well, look, this one supplier here, you've just paid them £10,000 that you didn't need to pay them for another 6 weeks.
Right.
So it's like somebody being there and actually thinking, where can I get this 1% gain? Where can I just move this cash versus equity gap by a couple of £1,000s every month? All of a sudden, you're going to just free up so much more cash in your business by just these tiny incremental process changes.
Yeah.
A good bookkeeper will do this, but it's fair to say that a bookkeeper will often be very busy with like putting the information into the system in the first place. So you have to ask yourself, if you have a full-time job for a bookkeeper, or you have a remit for a bookkeeper, which means do they actually have the time and experience to do that process improvement thing and really think about, okay, how can we actually free this cash up?
Yeah, got it.
So we went off on a little bit of a tangent there, but
I think it's valuable.
We have this cash versus equity thing. So we've got, obviously we can get our customers to pay us quicker. We can slow down payments to our suppliers. We can look at trying to minimize the stock that we hold, all of those types of things. And another really great thing to do is to finance your assets. If you don't have finance in your assets at the moment, then you can look to finance them.
Okay, interesting. Yeah. So again, going back to what I said about accessing the equity that's there.
Yeah. And that's something that we've onboarded quite a few new clients this year that for them, it's been really relevant that they have got under leveraged assets. Yeah. So they've got debts that they're paying off quite quickly, which is draining their cash flow. And we're saying to them, actually, do you know what? You probably only leverage about 60%. Why don't we refinance these debts, release 90% over a 10-year period, slow down your cash going out? And that's made a really significant difference to this cash versus equity gap.
Excellent. So what should people be doing? So I guess there's a number of things, isn't there? Like, what steps should they be taking to reveal this number? So how do they find that? Okay, so go to your balance sheet. Yeah. On a monthly basis, take your total cash balance. So that's going to be the value of all of your bank accounts added together. So it doesn't matter if you siphon money off into a tax account and a VAT account and a savings account, just add them all together. What's the total amount of cash that you've got sitting in bank accounts? Yeah. Okay. And find your equity. Okay. So again, that might be called shareholders' equity. It might be called owners' funds, capital and reserves. Just look for that number, that total at the bottom of your balance sheet that says equity. Okay. And you're going to take equity less cash. Okay. And if you get a positive number, so if your equity is higher than your cash, then you've got money tied up in the business. Yeah. If you're in the unusual situation where your equity is lower than your cash, then it actually means that you're cash positive. And the only time we really see that is if a business takes deposits up front from their customers. Right. Okay. That is a possibility. Great. Anything else you want to touch on this particular subject? I would say once you've got your number, so once you know what the gap is,
try and map out where that money is.
Okay.
So say X
Break it
amount
down.
is sitting.
Create your battle plan.
Yeah. So if it's 500k, go through your balance sheet and just pull out, we're not trying to get back to the pound and reconcile it, but we want to know, okay, if your number's 500k, okay, I've got 300k tied up in my debtors. I've got 200k tied up in fixed assets.
Yeah.
Just go through, because once you've done that, you can then see where the biggest win's likely to be.
You can get really emotional about this, can't you? Like as a business owner, like often I say, like with lots of the things that you do, like the first step with most business owners is you're basically taking the veil off and they're seeing these things for the first time. And then they're like, so, if you do this yourself and you go, like, that's £250,000, like, you should be physically annoyed and be like, I want that number to be smaller because I can put that money in my pocket. Or I can invest into my business. So how do I do that?
Yeah.
And it's like, go to town on this and go like, this is, like you just said at where you started with this is the one metric that's in every single one of your clients. It's really not powerful. Bespoke, because it's incredibly powerful, because it helps fund your growth, it helps fund your working capital, or it helps fund your life.
Yeah. Either way, it's going to be a benefit to you.
Yeah.
We sat down with a client. It was the first board meeting that we had this month with them when they've onboarded with us. We sat down and we showed them this number, like you say, that unveiling moment.
Yeah,
and once I'd explained it to them, they were like, holy crap, because they have nearly £2 million tied up in their business.
Because if you've never gone and looked or thought about that number or understood why it's there, you've definitely not put any processes or measures in your business that control that number. And what gets measured gets managed.
Exactly. What I would say is, if you're thinking about exiting your business, you might want to take a slightly different strategy.
Yeah, because that you just add that to the value of the business.
Well, what I was going to say is, if you're thinking about exiting your business, actually building up that gap, particularly if that gap is caused by debtors or by fixed assets, then often it's an opportunity for a buyer to come in and raise funds against your business.
Yeah.
So if you're thinking about exiting in the next couple of years, have a drop me a message and I'll give you a slightly different strategy to follow for this. But if you're running a business and you're focused on growing, acquiring and things like that, then reducing the gap is what you want to do. If you're exiting the business, depending on what your tax strategy is and your exit strategy, you might have a slightly different approach.
Yeah, great. Brilliant. That was fascinating, Claire. Thanks for walking us all through that. Hopefully everyone got lots of value from that. And if you did want Claire to have a look over your specific numbers, if you can't work out what that exact number is, if you just drop Claire a note on LinkedIn, I'm sure that if you give her access to your Xero or whatever else, she'll just run the number for you and tell you what it is.
The beauty of this is I can look on your year-end accounts. If you can tell me,
or even better, tell you. I can just look at your accounts and I'll tell you what that number is, and and then you can have a little bit of conversation about what the opportunity is there. It's a good one.
Do you know what I would say? This would be a really good little test based off the episode that we did last week about switching accountants and how do you know if it's time to switch accountants. Ask your accountant.
Yeah. Ask your accountant to give you that number.
And ask them to explain why it matters.
Why it matters, yeah. 2 questions. Oh, could you give me, what's the number they're asking for?
The gap between equity and cash and why it matters.
Could you tell me what my current gap between equity and cash is and what that value is? And could you tell me why that number matters to me?
And
interesting to see the responses. Yeah,
see what you get back from them.
Great. Right, let's move on to this week's Profit Cash Growth Extra. So this week, Claire, I've just booked a corporate away day.
Wow.
To Alton Towers. And this week, a little bit of fun because I thought this was pretty cool. But I'm going to do a track walk at Alton Towers in June. And basically...
on what track?
Well, I'm going to do Oblivion.
Shut at the front door.
I know.
Do you walk down the drop?
I don't know.
That must be impossible.
I'm pretty sure that you climb the ladder. You climb the ladder up, you do the walk across the top bit, and then you probably walk back. You can't, there's no ladder.
You can probably look down the hole, right?
Yeah, I would have thought so. There's no ladder that's down it.
That would be more like an abseil.
I will do this, but because they do 2 track walks. They do Wicker Man and they do Oblivion. My business partner Chris is taking his daughter on Wicker Man, so that's been like ring fence for now. But I will go on.
As a corporate away day, or
no? I don't. He's not mentioned that. He's not mentioned that he's going to put it as a corporate away day, but you never know. Let's see how generous we feel. So we're doing Oblivion. So I'll report after I've done it what I thought of it. But isn't this? I thought it was kind of clever of Alton Towers, because you remember when O2 did like the whole walk over the O2 thing?
They still do it.
Yeah, it's smart that they're coming up with new ideas, because it's not cheap. I can't remember, it's like 80, 90 quid or something. But I just think it's so something you want to do. It's like this experience thing that people just want more experiences, don't they? And they're like, they've got these, like, how ironic that they pivoted into, like, they've taken the maintenance ladder and walkway from the rides that basically used to access the ride for maintenance, and they've suddenly monetized it.
Yeah,
so
but
clever.
They've got to be careful about pissing people off, like the normal paying customers with this, because when I took my niece and nephew to Chessington a few months ago, and one of there's they're at that age where they're not into the kiddie rides, they're into like the roller coasters that are big at Chessington, but there's only, I think there's like 3 or maybe 4 of them, and one of them was shut. And so that was shut for maintenance. But if I went to Alton Towers one of them shut,
I'm going to be interested, because we are doing this on a weekday on a Friday and normal time. I'd be interested to see whether I don't think they'll shut the ride. I'm assuming we're going to do the track walk while the ride's going round. They will not shut the ride.
That you can't have people zooming around on a roller coaster.
They can't shut the ride. You can't shut the ride on a Friday.
I think the ride would have to be shut for maintenance, and so it would just follow.
So what do you do with the 2 hour? They've currently Ontaio's got like 2 hour queues. Anyway, I'm going to tell you after June. But
okay.
Yeah, look it up. So they do them. There's some other experiences on there as well. They do something on the Nemesis. It's not quite a track walk, but it's like a walk around the Nemesis track. Sounds like a track walk, doesn't it?
Sounds boring.
But yeah, so do check that out. I just thought it was really cool.
Coaster.
Take your whole team there. Team away day. Sounds amazing. Right. Thanks for joining us for another week's podcast. Hope you enjoyed that one. If you need to know what your equity to, God, I forgot the number already. Equity to cash
equity gap
is, as I said, get in touch with Claire if you can't find it. She'll just drop you the number, and then if your number is really big and you fall off your chair, she can then help you probably close it if you wanted. As always, please rate, review and subscribe to the podcast wherever you listen, and just share this episode with anybody else who has too much cash tied up in their business. And we'll see you again next week.